How do you get fixed yields, or how do you speculate on DeFi yields on certain protocols? So in this video, we're going to answer that by giving you an introduction to DeFi yield trading. So in this video, we're going to give you an introduction and a clear explanation about Pendle. What Pendle is trying to solve is that yields fluctuates just like token prices. It usually goes up in bull markets and usually go down in bear markets. And there are further micro factors in the protocol or in crypto or in the macroeconomic sector that usually cause fluctuations within these general market trends. So yeah, you can see here, this is the supply benchmark and the board benchmark. So the green line here is the yield that you'll be getting if you lend your assets into lending protocols like Aave, like Morpho, Compound. And the board benchmark here, the orange line, gives you the interest rate when you want to borrow from these protocols. So these yields actually fluctuate, right? And is there a way to actually lock these yields to get fixed yields like you will actually get on some coupon bonds like in traditional finance? Or even you can trade these yields, so you can speculate the yields going up or going down. So what is Pendle? So Pendle is a decentralized finance protocol that allows users to tokenize and trade future yield from interest or yield-bearing crypto assets. So for this example, we have 100 DAI staked in Compound. So in this example, 100 DAI staked in Compound actually gives you yield. By holding this asset, by staking DAI in Compound, you will actually get, for example, a 5% yield. And when we talk about yield here, we always annualize these yields. It's called APY. And in Pendle, you can separate this one token, this 100 DAI staked in Compound, into two parts. First is the principal token, and second is the yield token. Okay, this might sound confusing, but hang on for a moment, because I'll give you a very simple analogy. So think of principal tokens as owning a building. So suppose when you own a building, you can actually rent it out. You can rent out to people or you can live in it, but in this example, we'll be renting out the building to other people. And then you will get money from renting the building, alright? So the principal token here represents the building. It represents the right to own the building. So the building itself is like a principal token. We call it PT. So it's the core asset you own, and you'll always get it back in maturity. And the rent money here is representing the yield tokens. It's the right to own the rent money from the building. So this is the simple analogy to give you an idea of what Pendle does. It basically does these two main things. This is the two main products from Pendle. So on Pendle, when you deposit a yield-bearing asset, it will split into these two parts, the building and the rent. So in that way, you can decide whether you want to, using the analogy, you want to just keep the building or just the rent or both. So this is what makes Pendle unique. It turns yield into tradable asset classes. So farmers or DeFi traders can lock in predictable income using principal tokens. If you want the fixed rate, the PT token will be the token of your choice. This is the token you should be buying if you are looking for predictable income. It's predictable yield. However, when you are buying YTs or yield tokens, you are speculating on the future implied yield of the rent money that you will be getting from this building, alright? So let's just get into the example for this. First of all is to get fixed yields. In this example, we're going to explain how PT tokens work. By holding the PT tokens, you can redeem the principal amount after maturity, which will be after 3 months in this case. This will be very simple if you actually understand the concept of bonds in traditional finance. But in this case, let's just say we're all beginners. So I'll give you a very simple explanation on how to trade PTs on Pendle, and I'm going to go after this section because I will actually go through the protocol and show you how to do it. Alright, so in this example, let's just call him Bob. Bob buys one PTC DAI at 0.9 DAI. If you can see here, it's cheaper than 1 DAI because PTC DAI does not include the yield, alright? As PT stands for principal token, it doesn't include the yield. That's why you're buying it at a discount. So the PTC DAI and all PTs will actually be cheaper than one underlying token that they're actually trading on. So in this example here, for one PTC DAI, it will always be cheaper than one DAI, right? And so after buying one PTC DAI at a discounted price of 0.9 DAI, you can redeem it for one DAI for this PT upon maturity. This is a fixed return since the amount of DAI redeemable at maturity is fixed. I'm going to explain what this all means, the maturity and how to redeem. Redeem is basically to just collect back the PT tokens with a higher DAI value here in this example. So this is the very simple explanation here for PT tokens. So they let you get a fixed return. So if you want a fixed return, you get PTs, right? This is the predictable income for DeFi traders, right? So the second product we have is YT tokens. By holding the yield tokens, people here continuously receive the yield of the stake token during the entire duration of 3 months. Yeah. So for right here, people buys one YT stake ETH, right, at 0.00. Why is it way cheaper? Because you have to remember, one YT only represents the yield-bearing token part. So this is the part of the token that actually gains or earns the interest, all right? So that's why this will be way cheaper than a principal, all right? So definitely the building will be way more expensive than rent money. So this explains a very cheap YT. And yeah, for example here, people lucky and he gets like a 25% APY, and then the yield turns out to be 0.005 stake ETH. Here's to make it very simple. So these are the glossaries and what to watch when trading on Pendle or trading DeFi yields on Pendle. So first, you must see the underlying APY. So what the asset currently yields. You can see it right here. The line over here gives you the underlying APY. Okay? And the implied APY is the market's expectations. This is what you will be trading on Pendle. So this green line here is very important. APY stands for the profitability of holding YT through the maturity. So when you are buying YT tokens, you are actually expecting the yield or the implied APY to go up. If you expect the yield to go up, then you would buy YTs. But if you're expecting like, okay, this is a high enough yield for you and you want to lock in this yield, you can buy PTs. The maturity timeline is also very important to see, because for in this example, and we're going to look at more examples later on, for PT SUSDF, the video is recorded on 12 September, so in 12 more days, the maturity date will come into hand, and the time decay affects the PT and YT values. When the maturity date will be closer, usually the implied yield will go up because people will be selling PTs onto the market. Selling PTs onto the market means people are expecting the yields to go up, so that's why the yields are going up, and that's what happens on Pendle. The slippage and liquidity is also very important, especially for large trades or near maturity, as I was explaining before. Alright, so we're going to get into Pendle, and I'm going to show you the examples of how to trade yield on Pendle. So for example here, I'm going to screen for Ethereum, Base, and Arbitrum, because yeah, usually those are the chains that I trade on, and all the categories here. For this example, I'm going to give you a very practical and simple examples, like on yield trading on stablecoins. So stablecoins are getting more and more popular. That's why Pendle is actually getting more TVL by this time, because everyone's trying to trade the yield on Pendle. So you can trade the yield here, you can speculate on the yields here, you can go long or go short. You can go short by buying PT or go long by buying YT. So for example here, we're going to revisit this market. So we're going to click on the PT here on SUSDF. And if you are wondering what is SUSDF, for you guys who don't know, you can actually explore from the market information here. And from here, you can actually see the protocol that Falcon is actually building on. Yeah, SUSDF is from Falcon. You can see the implied yield here. It's pretty clear, and this gives you like a very detailed explanation on what you have to understand and what you have to pay attention to when trading yield on Pendle. So 1 PT SUSDF right now gives you a 29% fixed APY. So if you feel like this APY is already good enough for you, okay, that's a really good yield. But you must remember that it only lasts for 12 days. So it's very natural when these PT or YT tokens are actually going to expire as the maturity date is getting closer, it will be quite natural as the implied yields are actually getting higher and higher because people are actually selling their PTs, so that's why the implied APY can actually go up. So for this example, if you want to buy PT SUSDF, you can lock 30% for 12 days. If it's good enough, you can actually select from these tokens here. If you only have USDC, you can actually put on the amount that you like, for example, maybe like 1000 USDC, and yeah, from here you'll get an output of 1008 PT as USDF. So yeah, just like I mentioned, the PTs will always be cheaper than the underlying asset because this only stands for the principal token. It's not earning the yield that you would actually get when holding SUSDF only. So this is only the principal token. So this is what you will get. Yeah, so this is what you will get on the maturity, right? So you'll get like maybe $8 worth of 0.89% gain on maturity. So it's approximately a 29% APY, because when you actually lock in these yields, you have to also pay attention to the implied APY change. So for large transactions for 100K, for example, for 100K USDC, you can see here the yield going down. Okay, the yield going down because this is like the slippage, and the effective fixed APY that you will get is 29.04. It's not 29.9. So this is like the slippage you must pay attention to and see if it's still relevant for you. And for T's, it's pretty much the same. I don't have enough balance to actually trade that huge of a money here on T's, but please do remember that trading YTs is on the riskier side. So if you don't want to have too much risk, or you don't know how to correctly or reliably predict the yields of these tokens of SUSDF in this example, it would not be a good idea to actually trade YTs, because in my opinion, in my experience, I think YTs are more of an advanced side of DeFi traders, okay? In this example, you will actually gain a very super high APY, like 100% APY, if you actually buy YT tokens when the implied yield is 10%. So when the implied yield here is 10%, and you feel like, so SUSDF also have a points program going on. I'm not sure if the implied yield is supposed to be 10% or 9%, 9% or 10% here. Yeah, and you feel if this yield is undervalued, you can buy YTs. Okay, you can buy YTs. When the implied yield is below the underlying yield you can check directly on the protocol right here. The underlying yield that they're talking about, here's a 7 underlying APY. The darker blue one calculates the 7 days average, and the more volatile one is the daily APY. So that's why it's moving up and down quite frequently here. It's very fluctuative because it's a daily APY. You can check the 7 underlying APY to get a more reliable APY data. Alright, so in this example, going back here in example here, if you were to trade the YTs when this implied APY, the green line here, is actually trading below or around the underlying APY, you can actually long this yield and get like a phenomenal yield here. You can get maybe, in this point, you can get 300% or 200-300% APY by longing this yield. Okay, this is like a phenomenal yield you're going to get here if you succeeded to actually long the yield or buy the YT. Again, buy the YT, because you are speculating on the rent money you're going to get on this yield-bearing asset. okay? The yield that you're going to get in this yield-bearing asset. If you speculate it and you actually bought it here, you can get like a very handsome APY. So another example I'm going to give you is like for the, let me check, yesterday, the last few weeks, I just locked in this PT yield for YOUSD. And by the way, if you want to trade on these assets, you must know the underlying collateral of what is YOUSD. You can check out on their protocol, read their docs. If you want to know like the yield source of this yield-bearing asset, so for example, YOUSD is a yield token, and what the strategy is doing is like delta neutral strategies to get APYs, and these information are very useful when you want to trade yields on Pendle, because from that information, from that source, and from that narratives, you can actually figure out whether this yield is undervalued or overvalued. For example, when I saw this trading on like around 18 to 19%, I actually locked in those yields on PT because I thought at that time it was quite overvalued. For YOUSD, the implied yield should be trading lower than what I was seeing. When I locked in like a 19% yield here, when the yields dropped to 16% right now, I'm also getting capital gain. You can actually trade those PT yields if you don't want to hold it through maturity. Then again, let's move on back to the SUSDF market. This is another case scenario. If you lock in PT yields on the 10% here, and right now it's trading like almost 30%, you will temporarily lose money. It's called impermanent loss. You'll not lose money when the maturity really ends, but you can also trade these PT tokens. Like I mentioned before, when you're going to buy PT, you're expecting the yields to go down. If you feel the yields are overvalued, you should buy the PT. When you buy the PT, you lock in 10%, 11%, but then the yields went up to like around 20%, you will actually have some impermanent loss. But don't worry, because you will not lose money when maturity comes into date. So at maturity, you will still claim the amount of yield that you have locked in initially. So when you lock 13%, you'll get 13%. If you lock 11%, you'll get 11%. But for example, you bought in early, you bought in like 14% here. You bought the PT when the implied yield was 14%, and then it went down to 10%. Okay? You can calculate it yourself. There's a calculator, I think there's a calculator function here. Yeah, there's a calculator here on Pendle. You can actually use it and calculate like what happens when you bought it, when the implied APY is 14%, now it's trading on 10%, how much money will you be gaining, and that's called the capital gain, okay? So when you buy PTs and you'll go down, you'll get capital gain, right? So the best thing that was supposed to happen was like you buy PTs and then yield goes down and maturity comes, so you get capital gain and you'll also get the yield that you locked in. So that's the best case scenario for PTs, but that's expectations never come into hand sometimes in the world of DeFi or crypto. PTs or implied yields actually go up when maturity is about to end. This is an example here for SUSDF. And yeah, I think that's mostly it for Pendle trading. Do drop some comments if you don't understand, and we'll try to actually answer them in the comment sections below. Thank you.